Investors hoping for a bit of a rebound on Wall Street today after one of the worst days in months. You see it right there. The Dow actually closed down about 820 points lower yesterday. The S&P 500, NASDAQ hammered as well. A lot of financial experts say fears of rising rates is forcing people to get out of those high-flying tech names. Some say it could get worse. There's a lot of other factors involved. President Trump, by the way, who had taken a lot of the credit for the stock market's record run as of late, doesn't seem to agree.
Actually, it's a correction that we've been waiting for a long time, but I really disagree with what the Fed is doing.
All right, so what's behind the sell-off? We have so many factors: interest rates, global growth fears, the tariffs, profit-taking, deficits, oil prices. Let's talk about it with portfolio manager Doug Butler from Rockland Trust. First of all, Doug, it's really important on a day like this because some people might get really nervous and some of it might be well-founded, some of it might be unfounded. Yeah. Before we get to the reasons behind it, did you get a lot more calls yesterday and into this morning?
We started to get a pickup in calls yesterday afternoon, but not that many. Our clients know that we are long-term investors, and most of them are investing not for today, not for next week, but really for the next 10, 20, 30 years.
So does this sell-off, it's the biggest one since maybe last February, does it feel like something a little bit bigger? Is there a bit of a shift here, or is this something that we should discount a little bit?
I think, sell-offs occur. This is not something that we should discount completely, but there had been pent-up volatility in the market. The market hadn't really moved at all in the third quarter. So again, there was not much selling off that had happened, and it was just sort of due for, it was due for a break. Plus, there's election fears coming up. There's all those fears that you mentioned. So we may have some more volatility probably until the election.
Okay, I want to get three quick, really important questions in, and we don't have a lot of time. First of all, your just initial impressions as to why we had such a dramatic sell-off yesterday.
Oh, I think, rates rising. You had oil prices hit a new high. You have continued fears of the China-U.S. trade tensions. Like, those are the big three.
And those are all fears of inflation.
Yeah,
really.
Those are all fears of, projected inflation. And really, you're seeing that. And then you see this morning where CPI comes in a little weaker than expected.
And everyone breathes a little bit
of a sigh of relief.
Okay, listen, the second question is, you just talked about how you and your clients are long the market and you believe in the longevity of it, but what are some strategies for people who want to make sure they're protected?
Sure. I think one of the things is, in general, a good rule of thumb is you subtract your age from 100 and take that as how much equity exposure you should have overall in your portfolio.
Right, and so for lay people, equity is in stocks, and say I'm 47, so I should be 53% in stocks and the rest in some fixed income like bond markets.
Yeah, and that's a generic rule of thumb. That'll allow you a relatively smooth ride. Almost nobody should be 100% in stock, so if the market goes down 20%, your portfolio shouldn't go down 20%.
Right, and there's a lot of firms like Rockland Trust who could do the rebalancing for you, because you talked about this, and I want to get to it briefly. If you haven't checked your 401k in a couple of years, you might be so heavily weighted in stocks you don't even know it.
Right. The stock market over the last 5 years is up something like 70%. So if you had, if you had $10,000, now that's $17,000. Now your weights in stocks are much higher as a percentage, and you probably should be taking that back a little.
I wish we had a little more time to talk, Doug, but we appreciate it. Doug Butler from Rockland Trust. Joy, back to you.